This video will briefly walk you through accounting for debt investments that are considered trading security investments. And it's assumed that you've already walked through the held to maturity and available for sale maturity video and problems prior to this one, because I'm really going to briefly go through here what happens if we can now call it trading. And it's really the same problem that we went through for available for sale, except the only difference is it's called trading because we have an intention to sell it within the very short term, usually 3 months. And so here's the problem that's been given to you, the requirements that are asked. And so I'll just quickly go to recording the purchase of the debt investment at acquisition. The only change here is it goes to a trading security account rather than available for sale or held to maturity. Otherwise the dollar amounts are exactly the same, whether we call it any three of these. This portion of the problem is very easy. Acquisition. Adjusting at the end of the year. So year end here, again, the reason to do this is 1 year's passed. We don't get paid any interest this year. We have to accrue to earn the interest, show that we've earned the interest. And so the same amortization that we've had in all the other two problems still holds true. We earned the same 9502. We still use the effective interest method. And the only change here is that we are increasing the amortized cost of the trading security by the difference between the interest revenue and the cash received. So very similar, and then when we receive the cash payment the first of the year right here, right? This entry is the same. So no difference between available for sale and trading yet, other than the name of the account. So that brings us up to the mark to market. Now this is slightly different, although the values are the same, right? I've told you that the value decreased by $5,000 for the same rationale, and so at the end of year one we have a $96,000 amortized cost. Value went down by $5,000 according to the market, so we have an unrealized loss. Now notice, if you compare this to the problem we went through for available for sale, the only difference is this is called dash income, whereas the other one was dash equity. That's because the dash income notes that the unrealized loss goes through the current income statement. So in year one, we will have an unrealized loss on the profit and loss statement for this $5,000, where we didn't with this available for sale debt investment. And that's because this is going to be sold very quickly. The rationale is that the gain or loss should be pushed through the current year because that's going to be sold in such a relatively short period of time. So the last part of the problem is to dispose of the debt investment, and it's the same requirement as it was for available for sale. We're selling it at the 1st of 2012, which would be right here, and we're going to get $100,000 cash for it. This is our trading security account at the end of the first year. It has a cost of $96,529, and so when we sell it, we get the $100,000 cash amount. We get rid of the trading security for the total amortized cost, and we book an actual gain on sale, which does come through the current income statement, even though we've had a $5,000 unrealized loss from the prior statement. Now we're in this year we have a gain of $34.70. Then at the end of the year, same as we had with the available for sale security, is we've got this securities for value adjustment account, but this is for trading securities, and if we've sold this portfolio, and this is the only item in the portfolio, this amount logically has to be reduced or gotten rid of. So we debit the fair value adjustment trading account for the $5,000 right here, and then we credit the unrealized gain, which actually goes to dash income, noting that it goes to the current period's income statement. So if you look at the two gains here, you actually would have a gain in the current period of $8,470 that would go through the income statement in year two. And so that's much different from the equity method we use for available for sale securities, and it's really the only difference between the two methods. So I know that was very quickly. However, you're free to go back and review any parts you want through this video or any of the other prior two videos.